Hello. In question 2, we deal with IFRS 2, share-based payment. Beginner offered directors an option scheme. So that makes it an equity settled share-based payment scheme, conditional on a 3-year period of service. 3. The number of options granted to each of the 10 directors at the inception of the scheme was 2 million. The options were exercisable after the end of the 3rd year. Upon exercise of the share options, those directors eligible would be required to pay 2 Ghana cedi for each share of 1 Ghana cedi nominal value. The fair value of the options and the estimates of the number of options expected to vest at various points in time were as follows. So here you are given the number of options expected to vest. It means they've already dealt with those directors who will leave, the assumption of the directors who will leave over the vesting period. So you can see that we started with 10 directors and each was to have 2 million options, which means if all of them were there, all the 10 were to vest, would have had 20 million, options. But here, at the beginning, it was estimated that only 16 million will vest. And at the end of the year, that assumption was revised and estimated as 14 million. Then in the second year, 16 million. And in the third year, 18 million. So they all reflect the number of directors who left. At the beginning of the year, they estimated that 2 directors will leave. 2 directors will leave, which means it will be left with 8. And 8 times 2, 60 million. At the end of the year, they estimated that 3 would leave, and so 3 times 2 is 6, and therefore it will be left with 7, and 7 to 14. At the end of year 2, they estimated again that 2 would leave, and then at the end of 2020, which is the last year, the 3rd year, only 1 director left, which means they are left with 9 directors. So here you see that we have 9 directors at the end of year 3. So 9 times 2, 9, 18. That is how you interpret this. Secondly, because it is equity settled, and we know it's equity because it is option, share option. Because it is share option, it is equity settled, and because it is equity settled, you are only interested in the grant date value of the fair value of the option, the grant date fair value, and it doesn't change. So we are going to work with that. So this is what it will look like. So you see that at the end of year 1, 2018, 14 options vested, and with the grant date fair value at 0.5 and 3 years vesting period, we have 1/3. And so that gives you 2,333 for the equity reserve and for profit or loss. In the second year, we use 16 because 16 million options are expected to vest. Again, grant date fair value, it doesn't change. So you can see that for all the 3 years, it is 0.5. And it's year 2, so 2/3. It gives you this, and then the difference between the opening This is the opening and the closing, gives you the profit or loss charge. And then year 3, 18 million vested. And again, grant day fair value. And we have 9 million, which then the difference between the opening, which is last year, and the closing gives you the profit or loss. And therefore, if they vest, if all of them take up the options, option is the option to buy shares. So they will buy the shares and they will pay um, 2 Ghana cedi per share. So 18 million 18 million options by the 2 cedis that they will pay will bring in cash of 36 million. Cash of 36 million, and the entity has reserve of 9 million. This 9 million reserve will then be written off. So that, together with what they will pay, will be used to credit the share capital at nominal value and the rest in premium as you have it. So that is the journal entry. Now, this is equity settled. You must imagine what will happen if it were cash settled. So for the same figures, this is what the cash settled will look like. Because it's cash settled, the fair values will change at the reporting date. You use the fair value at the reporting date to remeasure the liability. Already at the end of 2018, it is 0.55. End of 2019, it is 0.57. And then at the end of 2020 is 0.6. And it is cash. And we were told in the question, those who did the cash settled, that half was how many directors? Let's look at the number of them. So from the question, 5 directors exercised their rights, share appreciation rights. 5 directors. So those 5, that's it, and they are going to receive cash of 3 Ghana cedi per the share appreciation right. 5 directors. So 5 times 2 is 10 million. And then they will receive 3 Ghana cedi per the share appreciation right. It is cash settled because it is share appreciation right. You have to know what will lead the transaction to be classified as equity settled and what will lead the transaction to be classified as cash settled. In the first scenario, it is share options. So it is equity settled. In this scenario, it is share appreciation rights. And therefore it is cash settled. So when they exercise, they will receive cash. Here, when they exercise, they will pay cash. So that's the difference. So with that, you have a payment of 30 million, and then 4 of them wouldn't have taken up the right. So those 4 must be remeasured, and therefore the remeasurement of the 4 is at 0.6, and that's the closing liability, and therefore the difference to the profit or loss is 28,720. If you are not too sure and you want to look at this as a T account, you may want to just do the T to illustrate this. So to show this as a T account, let's see. Okay, so this is your provision for cash settled share based payment. So balance from last year, the previous year, and the previous year in this case will be 2019. Balance from the previous year 2019 is 60 80. Your balance for this year, which is balance carried down, is 4,800. And then we also established that we'll pay cash. I'm dealing with these issues. You pay cash of 30 million. So if you do the T, then you know your profit or loss will be 28,720. So that's how you determine your balance for the statement of profit or loss. So anytime you are in doubt, just prepare the T to get those balances going. So if you were going to do the journal entry, you will debit the provision 30 million. That's it. You debit provision 30 million and credit cash. We are paying cash. The entity is paying cash. And then you will debit profit or loss with 28,720 and credit the provision with 28,720. That is what the journal entries at the end of year 3 will look like. So the cash settled share-based payment again at the end of year 3 2020, these are our relevant figures. 30 cash payment, the closing balance will be 48, and then to profit or loss we'll have 28,720. Cash payment of 30,000 to the employees, the 5 who have exercised, and 28,720 as the staff cost to debit to profit or loss. So this then will be your journal entry. Thank you.